Hi, everyone. I'm August Biniaz here with CPI Academy. I'm joined by 𝗖𝗑𝗶 Benesocky. Welcome, Ava.
Thank you, August.
We host the CPI Academy YouTube show dedicated to adding value to our viewers' investment journey. We bring on experts to discuss all topics related to real estate investing.
Thank you, August. And hello, everybody. Thank you so much for joining us today. Today, we are joined by Brian Adams. Welcome, Brian.
Welcome, Brian.
Thank you all for having me.
And you shared a name with a famous Canadian singer, I believe, right? Brian Adams. So
he's actually a pop sensation. So let's make sure, not just a singer.
Right, correct.
Yeah.
There you go.
Exactly. Awesome.
Brian, can you please start off by telling our viewers about yourself and your background, please?
Yeah, absolutely. Well, first off, thank you all for having me. Very exciting to watch your growth, and I'm excited to participate in this event. So I'm from New York originally. I went to college in Connecticut where I met my wife, who is from Nashville. We did the Northeast thing for a little bit. I went to law school in Boston, eventually moved to Nashville, Tennessee, where I've been for the last 15 years now. And I practiced law for a number of years here in Nashville. My wife's family has a single family office based here. So once I joined the board and I got exposure to some of the investments we were making, both in private equity and venture capital and commercial real estate, I became enamored with the industry. I connected with my business partner, who's also a New Yorker that married a Nashville girl, and we started our company 11 years ago now. And initially started raising small kind of blind pool commingled funds, and have then transitioned probably for the last 6 years into the syndication business. So purely raising money on a deal by deal basis from a network of high net worth individuals, families, independent RIAs, and boutique wealth managers. And we focus on the commercial space. So for us, that can mean anything from office to industrial to flex to medical. But what we do is really pretty straightforward and simple. We provide people access to direct co-investment opportunities. We provide double-digit cash-on-cash yield, and we give taxable investors all the benefits that come from direct real estate ownership, so that hopefully on their K-1, they can show a loss, they can offset gains elsewhere in their portfolio. And to give a little bit of context, today we run about 2.7 million square feet across 14 markets, and it's roughly a $400 million kind of gross asset value portfolio.
Great. And what is the ratio between office space and multifamily and the asset classes?
Yeah, I would say the majority of it is suburban office. So that's probably 75% of the portfolio. And then the remainder would be kind of that flex industrial medical. We don't do any multifamily, no single family.
Okay.
And do you have any plans to possibly get involved with multifamily? You're very focused on asset class.
Yeah, it's obviously a very competitive space. And, for us, we just, we don't have that expertise in-house. And so we're going to stick to our knitting and focus on these commercial assets that we have good brokerage networks in and experiencing managing and dispositioning of.
Great.
Okay, right on. Brian, can you please explain to our viewers what is a family office?
Yeah, it's a good question. And it's a squishy term that gets thrown around a lot. I used to think that it was a function of how many zeros you had behind your number, like an AUM distinction. But after being in the space for a while now, it's really more of a mindset, right? So a family office can mean a lot of things to a lot of people, but fundamentally it is a corpus of assets that is meant to provide and maintain a quality of life across a multiple generation time horizon and avoid paying taxes. Many ultra high net worth individuals or families may have enough funds to have their own family office, but if they don't have that mindset or ethos, then they don't qualify for one, in my opinion. So that's the definition that I use.
Great. And we have a We have an interesting kind of a joke that we use, me and Ava, an experience that we had. So I studied a bit to kind of understand what is a family office and what is a qualification for a family office. And just as you mentioned, it's viewed differently on the net worth and what is a group worth. And we were on Clubhouse, a platform I'm sure most of you are familiar with. But there were all these different people coming on. Hey, I manage a family office. I manage a family office. And I'm like, I was looking at the people's profile. I'm like, this person, I don't think they're a family office. And I don't think they're a family. And they call themselves a family. And Ava is like, you know what you sound like? You sound like saying, you're not a family office. You're not a family office. You're like calling everybody out on Clubhouse. I wasn't calling it, but it was just funny.
There's a little insider joke that we had in the background. So I was excited to hear your opinion of what a family office is. So thank you for sharing that. That is, definitely.
For sure. I have a couple other questions about.
Please do.
So on that family office topic, so let's say a family who the patriarch or the matriarch is someone who's running a very large company. The person either retires or is deceased, and now the family ends up with a huge amount of capital, and now can that family, that group, make the transition in becoming a family office and bringing on certain consultants and advisors to then create an actual office that manages their capital? Because if you end up with $1 billion as a family and you're not in the business of managing capital or being in real estate, or you've been focused on other things, it makes sense to, I'm just using my logical mind, it makes sense to bring on such advisors and experts to manage your money for you rather than just investing it with financial advisors or what have you.
Yeah, absolutely. And I think what you often see happen, or a fact pattern that we run up against a lot, is a family that used to have an operating company, or they made widgets, or they invested in timber, whatever it is. Oftentimes, after the liquidity event occurs, they've realized that they've kind of lost access to that operating company, obviously. And so they're now a purely financial family, and they will form a family office to try to maintain the economic returns that they were experiencing being an operator through financial instruments. And I think what's really important to understand, and what a lot of people don't fully appreciate, is if you just do the math, right? So if you think, okay, well, inflation is going to be 2 or 3% a year, and your spend rate, like your overhead expenses to maintain that quality of life, are probably going to be somewhere between 4 to 5 to 6% a year. And then your family grows exponentially, typically. So 2 children have 2 children, etc. The returns that the family needs to generate on an annual basis, they probably need to be somewhere between 15 to 20%. So it's a very difficult thing to manage. Even if you have a large corpus of assets, it's a huge challenge. And inherently, you need to take risk there. And the lament I hear oftentimes from families is, after taxes, net of fees, I wish I just kept my operating company, because achieving those returns over the long term is a real challenge.
Right. And maybe you can touch on those tax advantages of direct real estate investments for your clients.
Yeah, so we only work with taxable investors. They're all accredited, but we don't have any institutional folks in our deals. And we do what's called a cost segregation analysis, which then allows for accelerated depreciation under the Trump Tax Act, which hopefully will show a loss on your K1 for 1 or 2, maybe 3 years, which you can offset gains elsewhere in your portfolio. So I tell people all the time, you hear don't fight the Fed. I think that's true, but you should also not fight the IRS tax code. And the tax code is clearly incentivizing you to invest in commercial real estate, given all of the benefits that has. So we try to take full advantage of it. We have a controller in-house who is a public accounting tax background, who can't give our investors tax advice, but he can work really closely with our tax providers as well as our investors' tax professionals.
Great, great. And is your company's focus obviously is assisting family offices and high net worth individuals? Your start was through your significant other, and as she was part of a family which needed potential services. So talk to us about how do you now? We have a good friend of ours who he was part, his own family had a family office, and then he grew up with other children that were also part of family offices. So when he got
he found out, I think when he was 17, that he had his family had all this wealth, and he had to start managing his family office, and now he represents family offices around the world. So that was kind of his start. So how does one start being an advisor? Sorry, I guess I jumped in.
Of course, please.
An advisor to family offices.
Yeah, I mean, I think a lot of people in our space view family offices as being this ability to unlock all of the riches of the world and the solution to their funding problems, and they're just going to open up their checkbook. What you have to realize is, if you come at it from an empathetic standpoint and you take a step back and you think, okay, well, these might be ultra high net worth individuals, and this family may have a large corpus, but they're just people in families, and people in families have problems, right? They're crazy, things change, they have internal dynamics. And again, that pressure to achieve a set amount of returns is real. And so I think the best way to advise these families and to build those type of relationships is to come at it from being a resource and being helpful to them. Because I think oftentimes, people approach them thinking that they don't have any issues, that they've solved all their problems, that they just, jet around the world going from one fabulous location to the next. And that's oftentimes just not the case. These people are working very hard. They're working on the qualitative as well as the quantitative issues involved in running their essentially small business. And they have problems. So if you can help solve those problems, be a resource for them, you will build that relationship over time. And as a natural consequence, investing will come up, but you can't just cold pitch them. That's I think a wrong approach, and not all of them are essentially capital allocators. They're not institutional groups for the most part. So I think just being empathetic and understanding that they've got problems that you might be able to solve based on your relationships and your network is the best way to go about it.
Great point. Now, there's a topic that we always discuss here at CPI and between me and Ava, and we discuss diversification. So when it comes to a family office, even though a certain family office's focus, their focus is on a certain asset class or a certain business, as an advisor, do you offer or do you propose diversification in their investments? And talk to us about that, if you don't mind.
Yeah, absolutely. I think given what we're doing, which is yield generation and income producing assets, we're not in the wealth management business, right? So we're not looking to get all their AUM. That's not what we're doing. We're providing a small replacement for a fixed income or a bond portfolio or a private credit portfolio that's been underperforming over the last cycle. And so from an allocation perspective, typically the question we get often is, okay, well, how many of these deals do you think you're going to do a year so I can set aside enough dry powder to participate? And that typically is a percentage of their liquid net worth, right? So that when you hear the adage that when you've met one family office, you've met one family office, this is where it really comes through, because the asset allocation and the risk appetite is very different from group to group. And so that percentage is going to change fairly dramatically. But I think just being really straightforward and honest with what your return profile and expectations can be is the best way to advise them when they're thinking through that asset allocation.
Great. So essentially, your group is an investment vehicle that family offices, high net worth individuals can utilize tax efficiently to grow their wealth. Is that a good way of putting it?
Yeah, I mean, we're income producing stable properties, so we're not going to go out there and hit a huge IRR. We're not getting these crazy big multiples, but if you want good, steady monthly distributions and dividends, we're a good solution.
Okay, right on. Now, Brian, let's discuss Nashville, Tennessee. I know that's where you're located, if I'm correct. Are all your assets in Nashville, Tennessee, or maybe you can discuss on the areas that you guys target?
Yeah, absolutely. So out of 2.7 million square feet, only 20,000 square feet is in Nashville. We have cashed out of the majority of our positions in town. It's become an exceedingly expensive place, a wonderful place to live, but cap rates are terrible. And it's more or less an institutional market now. And so we just can't really afford to buy stable product here. So we're in 14 different markets across the Southeast and Midwest. And we have the flexibility because we are a fundless sponsor to go where we find opportunity. So we have holdings in Tampa, Raleigh, Kansas City. We're doing something in West Palm Beach right now, closing a deal in Chattanooga, hopefully this week, knock on wood. So we're pretty broadly diverse and distributed across what I would call secondary markets.
Great, great. And do you partner or do you bring on asset managers or active operators to either partner with you or oversee the assets you're looking to purchase and potentially upgrade and manage?
We're the operator sponsor. So we manage the assets, we raise the capital, we do the whole thing soup to nuts.
Got it. And to kind of discuss with us. So if you come in, if a deal comes across your desk and the numbers really make sense, you believe in the area, but it's an area that which you haven't had a physical presence in the past, what is the process in potentially finding the right asset manager or the right team to be your potential boots on the ground? Or do you have a mobile person who oversees that process?
Yeah, so we third party manage and lease. So we will bring in a JLL or a Cushman or a CBRE. Every market's a little bit different about who they have there, but we'll run a bake off. If it's the first time that we're owning something in the marketplace, we will talk to all the local operators or local service providers and figure out who the right fit is for the property themselves. I will say that we have a huge bias towards using CBRE as property management because they have great systems. Their financial reporting is terrific, and they're pretty much in every market. So we usually will use CB. On the leasing side, oftentimes we get off-market deal flow from leasing brokers. And so we will say to them, hey, if you give me an off-market look, or if you give me a 30-day advance, we'll keep you on the leasing work, or we'll give you kind of preferential treatment as we go through that process. But every deal is a little bit different. Every market's a little bit different.
Got it. And let's discuss the asset class. Let's discuss commercial office space. Obviously, as you know, our world has changed as this idea of working from home. Many larger companies deciding to work from home. Well, how do you feel about this asset class? And kind of give us your viewpoint, because I earlier asked you, hey, do you guys have any kind of plans to move on to multifamily? And you unequivocally said, no, this is the asset class we were focused on. So tell us about, how do you feel about the asset class? Where do you see it going? And tell us about that more, if you may.
Yeah, so it's interesting, right? I've been having this conversation for over a year now. And when COVID first happened, it was office is dead. There's going to be a fire sale, huge disruption. There's going to be large defaults. End of the world is coming.
Right.
And probably 6 months into COVID, people started experiencing burnout from work from home. People felt isolated and depressed. That spike in productivity that we saw initially started to wear off. And you start to hear more and more C-suite executives and employers talk about lack of creativity, lack of dynamism, inability to collaborate, can't bring on new hires, hard to get new marketing efforts off the ground. Sales groups were struggling. And now, just within the last 30 days, as the vaccine has been rolling out in the States pretty aggressively, you've been hearing a return to the office, how everyone's desperate to get back, and that, maybe we need less square footage, but it's still going to be a huge part of our lives. We felt pretty confident. I mean, we probably have over 2 million square feet of suburban office. We've maintained just the pretty much monthly kind of high 80s, low 90s rent collection, high 80s, low 90s occupancy. What I do think you'll see is a lot of employers are going to figure out the right way to utilize their space. So new leasing and maybe lease renewals are going to be a little bit slow, but I do think they're going to pick up pretty dramatically, especially after Labor Day, when everyone comes back from the summer holiday and they're eager to get back into the office. And the economy is really picking up steam. So I think Q3 and Q4, everyone's going to be very busy across the board. But if you think about pre-COVID, 4% of the workforce worked from home or worked remotely. Clearly, that's going to be a bigger number post-COVID. But at the same time, this trend line that we saw with this WeWork effect of massive densification, hoteling, benching, hot desking, the pendulum will swing the other way, where people are going to want, 350 square feet per user, traditional office layouts, and or multi-purpose, multifunctional spaces where they can do collaborative teamwork, get everyone in there 2 or 3 days a week to do that kind of groupthink, and then allow them to work from home 2 days a week. I think that's a natural consequence. And I think increasingly you'll see a hub and spoke model where maybe corporate headquarters will still be in New York or San Francisco, but because of the demographic shift we've seen play out over the last year, some of those secondary support offices are going to be distributed across secondary markets in the interior of the country. And bottom line is the West Coast and the Northeast are going to have to increase taxes and decrease services to take care of their budget shortfalls. And they're going to do that by taxing affluent people and business owners. And they're going to realize pretty quickly that they're mobile. So they're going to be relocating in more and more. And I think places like Texas and Florida and Tennessee and the Southeast and secondary markets in the Midwest, where they can get good quality of life and cost of living, make all the sense in the world. That's good for us.
Amazing.
Right on. So August looks like our bet there is probably 50-50.
Yeah.
My bet was people would be excited to go back to the office because there's so much distractions at home, including if you have a family and so
Children
forth.
running
And,
around, yes.
And so there you have it. Thanks for that, Brian. That's great. Now this is a really exciting question I'd like to ask Brian. As we service Canadians, we partner, we pull together Canadian capital to then deploy it into the US, of course, with our web corporations and limited partnerships. But Brian, do you service Canadian investors as well?
On the family level or the high net worth individual?
Yeah.
Yeah, 100%. We welcome, obviously we have we use domestic US lenders. So there are some KYC and OFAC issues that we need to work through sometimes, depending on the percentage ownership. But we've worked with groups out of Canada, out of Israel, out of Europe. And so we have, a lot of flexibility there.
Oh,
great.
Cool.
Awesome. So we can add Brian to our list of regional asset managers in a few moments here.
Yes. 100%.
So great. So now,
collaborate with them.
Great. So, I mean, we're just a few more questions here for you that I have. So now you partner and service with family offices through the networks you have, but also high net worth individuals. Talk to us about that process of someone with your background. Obviously, I presume you went to law school, so you are a licensed attorney.
Yeah, I've retired my license technically in Tennessee, so I can't give legal advice any longer, but I am still barred in the state. Correct.
Oh, you're still barred. You're still a member of the bar.
Yeah.
So someone with that background, obviously, how do you build relationships with high net worth individuals? Obviously, as us managing a Canadian fund, we're approached all the time by different associations, groups, products that offer for us to be able to rub shoulders with high net worth individuals and family offices. But someone who is in the space, who has had clients in the past, how do you go about growing those relationships or building those relationships with these individuals who even though they're made to seem they're unhuman, they're actually human. They got their own issues. They're just like all of us. They're nothing out of this world. So talk to us about that process. Do you golf with them? Do you go to country clubs, or do you just go have a burger, or like how does it work?
Yeah. So I'm a member of a country club here in Nashville, and I own golf clubs, but I'm not a golfer. So that's not really my thing, unfortunately. It's interesting. I did a presentation about this, like how to raise capital recently. And I think oftentimes, and I was certainly guilty of this, when you first get into the business, you have your product, you have your shiny object that you're really proud of, that you worked hard on, and you spend all your time and effort putting the product together, the offering, the investment. And then you realize, man, I've got to go raise capital around this. And so you go to your friends and family and you try to cram it down their throat, right? You tell them like, you need this, you should do this. I'm smart. It's a great deal.
Yeah.
And most of that pitch is about you. It's ego driven. It's I'm really smart. I found this great deal, blah, blah, blah. That you can do it. It takes a lot of work. I mean, I used to do 5 meetings a day and 10 phone calls a day. That was my goal for every day. And that brute force methodology will work to some extent. It'll be hard. A much better way to do this is to go to your natural organic network, people that that maybe potentially would give you their resources in return for your investment, and ask them what they want, and be empathetic with their problems. And to your point, if it's not so much of a pitch as it's a, hey, I'm delivering a solution set to the issues that you told me that you had, and this will solve some of your financial problems in your life, which for us was access to direct deals, yield, tax advantages. And if you give them that product, you just say, hey, Bill, I found this deal. It checks all the boxes for you. The minimums are right within what you said you would be able to do. Let me know if you want to participate. That's a much better conversation than it is going and hard pitching them. And we used to just send an email and then send another email and then send another email, and then you get a phone call. And now with technology and the way that we go about providing content, doing co-branded, being an educational resource for people, I mean, the fundraising kind of takes care of itself because we know exactly what our folks want and we're delivering it to them. So in terms of expanding my network, doing things like this, doing co-branded content pieces with synergistic professional and service providers, podcasts, webinars. We do a lot on the resources side in terms of white papers, blogs, thought pieces, etc. And you just try to, provide as much content and education pieces as you can. And I think you become a magnet for like-minded people and investors that want to be part of what you're doing. That's how I've always kind of thought about it. And really, COVID forced me to do a lot of these things that I just was hesitant to do before because I was scared to put myself out there. But it changed the entire business for me. We've gone from 1,500 people on our distribution list to just about 6,500 now.
Wow. There you go.
Great. Awesome.
I love the educational approach. It really pays off, and people kind of gravitate towards you because you're the thought leader.
Absolutely.
Correct.
And we'll definitely share all your contact information below the YouTube video. So any family offices being in Canada or the US can get in touch with you.
Of course.
And high net worth individuals and other groups. I guess, possibly our group can, go into discussion of possibly partnership and see where that goes. So we really appreciate everything, and we really appreciate the information. We learned a lot.
Yeah.
We hope that we also add value to our viewers.
And if anybody has any questions for Brian, please feel free to type it in the Q&A. We could ask him right here live.
I'll also add for your Canadian audience that I grew up in upstate New York, huge hockey player, huge hockey fan. So if you just want to talk puck, I'm happy to chat. I have like an emotional relationship with the Nashville Predators that is borderline unhealthy. So if you want to just talk about the trade deadlines coming up, I'm happy to chat about all that kind of stuff.
Awesome, great.
Canada hockey guy, yeah.
Well, I mean, if the Winter Olympics get boycotted, people are going to lose their minds up there.
For sure. So we'll conclude our YouTube portion of or do you want to ask that there are a couple of questions that you always ask our
Absolutely.
guests?
Yes, absolutely. We actually like to ask our guests, what is your number one best advice that you would give to somebody who's looking to passively invest?
So this could be a family office or high net worth individual. What should they, especially if they're looking to invest with an operator such as yourself or ourselves, what should they look for? What would be your number one advice?
There you go.
Yeah, it's a great question. And I think the biggest takeaway I've had after doing this for over a decade now is you can ask a lot of questions about the deal, and you should ask a lot of questions about the deal. Really dig on the diligence, etc. The questions that people don't ask, which is really interesting to me, is aside from this particular deal, what are the pieces of the infrastructure of your small business that support your overall real estate investments? So I would urge investors to ask questions like, what do your marketing efforts look like? What do your sales efforts look like? What do your investor relations look like? What can I expect from a reporting standpoint? How do you manage your tax and audit situation? How many people are on the team? What's their background? How do you manage HR? Do you have key man insurance? All of these things that underpin the investments themselves, because you have to remember the fractionalization of commercial real estate investing is only doable because people have the ability to raise capital from multiple people. So these minimums that you can afford to allow people in at, you have to be able to go out and raise the rest of the capital. And so I think oftentimes people don't ask enough questions about what the investor experience will be like, what the expectations could be on a monthly, quarterly, annual basis. If I call you or email you, when can I expect a return call or email? And now we just kind of front run that conversation and tell people what to expect. But I think oftentimes investors don't ask those questions, and sponsors don't want to go there because they're afraid it will ruin the pitch. So that would be my big advice, because I think people realize that everyone hopes the deal will be great because I get paid, you get paid, that's terrific. What are more interesting questions to me is, how have you built your small business that helps support these real estate investments? And they're two different risk profiles.
Great advice, great
That's
viewpoint.
Fantastic.
But
yeah,
but this just brings up another question. I was going to conclude that portion, but I think this is important. So in your offerings, in your investments, do you allow for retail investors to participate, or is it only for you do allow for
you need to be accredited, but yeah, I mean, we have low minimums and yeah.
Great. Accredited investors can participate, but obviously your company's focus is high net worth individuals and family offices. And how do you organize the capital stack? So you do the institutional investors sit differently on different positions within the capital stack as far as the common equity or debt? The debt. How do you structure that, if you don't mind?
Yeah. So we've done this the wrong way before, and we don't do that anymore. We don't work with institutional groups. We don't commingle institutional and non-institutional folks. We only work with accredited taxable investing entities. Everyone's common equity, everyone's pari passu. There's senior secured debt, and then there's common equity. That's it. Super clean.
Got it.
Okay.
Perfect. That makes sense. Okay, awesome. Really appreciate it again. Thank you so much. Please, everyone, hold on a moment and we'll have the Q&A. But this concludes our YouTube portion. Thank you. Thank you, Brian.
Yeah, thank you all.